Let's be brutally honest about something the financial industry would rather you not think too hard about. The so-called conventional wisdom around retirement withdrawal order is not some neutral, one-size-fits-all solution handed down from the mountaintop. It is a generalized default strategy built for the average person, and if you are reading this, you are probably not average. You are someone between 55 and 62, sitting on a mix of accounts, watching the clock tick toward retirement, and wondering why the math never quite seems to add up the way the brochures promised. Here is what the glossy pamphlets leave out. The sequence in which you pull money from your taxable, tax-deferred, and tax-free accounts does not just affect your annual tax bill. It compounds, it snowballs, and over a 20 to 30-year retirement, it can mean the difference between leaving a legacy and quietly running out of runway. The people quietly winning at retirement are not necessarily the ones who saved the most. They are the ones who got ruthlessly strategic about the order in which they spent it. If you have been following the standard retirement withdrawal advice, there is a very real chance you are leaving tens of thousands of dollars on the table, and your financial advisor might not even be telling you about it. Today we are breaking down the retirement tax strategy that most people never question, the one that gets handed down like gospel from every personal finance book, every talking head on television, and every well-meaning advisor who learned it decades ago and never looked back. We are talking about the so-called optimal account withdrawal order, taxable first, tax-deferred second, Roth last, and we are going to expose exactly why blindly following that rule could be one of the most expensive mistakes you make in retirement. Because here is the truth. The conventional wisdom is not wrong for everyone, but it is absolutely wrong for more people than you think. And the difference between getting this right versus getting this wrong is not a rounding error. It is real money, your money, that either stays in your pocket or quietly disappears into Uncle Sam's. What if the retirement strategy your financial advisor swears by is actually costing you tens of thousands of dollars? The conventional withdrawal order, spend taxable first, tax-deferred second, Roth last, sounds bulletproof on paper, and for decades it has been treated as gospel. But here is the uncomfortable truth that most retirement guides conveniently skip over. Blindly following this sequence without understanding your specific tax situation is not playing it safe, it is playing it wrong. We are talking about the difference between a retirement that lasts and one that quietly bleeds out through unnecessary tax bills. So before you follow the crowd off this particular financial cliff, let us break down exactly why the so-called conventional wisdom on withdrawal order deserves a serious second look. Let's be brutally honest about something the financial industry does not want you to figure out on your own. The conventional retirement playbook, the one your parents followed, the one your co-worker swears by, the one plastered across every generic financial planning website, was written for a world that no longer exists. We are talking about advice built for people who retired at 65 and lived to maybe 72. That math is ancient history. Today, you are potentially staring down 4 decades of financial life after you stop working, and if you are still operating off the old rulebook, you are not just leaving money on the table, you are quietly torching it. The people who win at retirement in the modern era are not the ones who saved the most. They are the ones who understood the rules of the game well enough to rewrite them in their favor. So, if you have ever Googled retirement planning tips and walked away feeling like you just read the same recycled nonsense for the 100th time, you are in exactly the right place, because what comes next is the stuff that actually moves the needle. Here is where the conventional order starts falling apart, especially for people between 55 and 62. This stretch is often the lowest income period of your entire adult life. Think about it. You may have stepped away from full-time work, scaled back your hours, or transitioned out of a high-earning career, and you almost certainly have not started Social Security yet. That combination means your taxable income has dropped significantly. Your tax bracket is unusually low, sometimes the lowest it has been in decades, and yet most people in this exact situation are still defaulting to the standard playbook, spending from their taxable accounts first and leaving their traditional individual retirement accounts and 401ks completely untouched. That feels safe, it feels logical, but it is quietly setting up a very expensive problem down the road. Here is a concept that changes everything once you understand it. Look at your current income and then look at the top of your tax bracket. That space in between is not just empty numbers on a form. That is essentially free or deeply discounted tax space that you are allowed to use right now. Most people in this age window are sitting in the 12 or 22% bracket with room to spare. Meanwhile, their traditional individual retirement account, or 401k, is compounding every single year, growing larger and more expensive to access later. Doing absolutely nothing with that bracket gap while your tax-deferred account balloons is not a neutral decision. It is an active mistake, one that quietly costs retirees tens of thousands, sometimes hundreds of thousands of dollars over the course of retirement. This gap is your opportunity. Here is the uncomfortable truth that most financial advisors will not lead with. Doing everything right on paper can still leave you handing a massive, unnecessary check to the Internal Revenue Service in retirement. If you have been diligently maxing out your traditional individual retirement account, patting yourself on the back for your discipline, and assuming that tax-deferred means tax-advantaged forever, this video is going to reframe everything you thought you knew. We are talking about a strategy gap that quietly costs retirees tens of thousands, sometimes hundreds of thousands of dollars, not because they were reckless, but because they were following outdated conventional wisdom. The people getting crushed by taxes in retirement are not the ones who made bad investments. They are the ones who never ran the numbers on what happens when the Internal Revenue Service finally comes to collect on every single dollar they so carefully saved. Let me be blunt with you. If you retired early and you are not doing Roth conversions right now, you are leaving one of the most powerful tax advantages in the entire retirement playbook completely untouched, and your future self is going to feel that pain in a very real way. This is not some obscure loophole that only certified financial planners whisper about in backrooms. This is a legitimate Internal Revenue Service approved strategy that sits right in front of most early retirees, and the majority of them walk right past it like it is invisible. You worked decades to build that nest egg. You optimized your savings rate, you maxed out your accounts, you did everything right, and now you are going to let a preventable tax explosion eat through it in retirement. Absolutely not. The window you're sitting in right now, between leaving work and the moment required minimum distributions kick in, is arguably the single most valuable tax planning opportunity of your entire financial life. Miss it, and you do not get a second chance. Let me ask you something brutally honest. What if everything you have been told about saving for retirement is actually setting you up for the biggest tax bill of your life? Because here is the dirty little secret that your traditional financial advisor conveniently forgets to mention: that beautiful, growing tax-deferred account you have been proudly building for decades. The Internal Revenue Service owns a massive, undisclosed percentage of it, and they get to decide how much they take and exactly when they take it. Every single dollar sitting in your traditional individual retirement account or 401k is pre-taxed money, meaning you have never actually paid what you owe on it. So, when people brag about their retirement balance, they are bragging about a number that is not entirely theirs. The government is a silent partner in your nest egg, and unlike you, they never retire. The question is not whether you will pay taxes on that money. The question is whether you will pay on your terms or theirs. And right now, for a very specific window of time, you actually have a choice. But that window is closing faster than most people realize, and the ones who ignore it are going to feel it in the most painful way possible, at the exact moment in life when they can least afford a financial gut punch. Now let's layer in something that makes this conversion window even more powerful. If you delay Social Security until age 70, which is absolutely the right move for most people seeking maximum lifetime benefits, you are not just getting a bigger check. You are extending your low-income window all the way from 62 to 70. That is 8 full years where your taxable income stays intentionally low. 8 years where you control exactly how much you pull from your tax-deferred accounts and convert to Roth at discounted rates. Most people see delaying Social Security as a sacrifice, a period of going without. But when you understand the conversion strategy we have been discussing, that 8-year stretch transforms into one of the most valuable tax planning opportunities you will ever encounter. Most retirees completely ignore this, or simply never connect these two strategies together. Here is something most financial advisors never bring up in the conversion conversation, and it might be the most emotionally important reason of all. When one spouse passes away, the surviving spouse loses the ability to file jointly. They drop to single filer status, often starting the very next tax year. That means the exact same income that was taxed at one rate is now taxed at nearly double. The same Social Security, the same required minimum distributions, the same everything, but now squeezed through a much tighter bracket. A Roth-heavy portfolio at that moment is not just a smart financial move, it is genuine protection for the person you love most. The conversion window between 55 and 62 is not only about your future, it is about building a financial shield for whoever comes after you. Now let's slow down on the taxable account, because not all taxable accounts are created equal, and this is where most people make a quietly expensive mistake. If you are holding assets that have significantly appreciated over the years, selling them triggers capital gains taxes. But here is the part most people never hear about. When you pass away, those assets receive what is called a step-up in basis, meaning your heirs inherit them at the current market value, completely wiping out the embedded gain. So sometimes the smartest move is actually to hold appreciated taxable assets rather than spend them first. This reshuffles the conventional spending order in a way that surprises even experienced investors. The taxable bucket is not simply first in line. It requires a careful look at what is inside it before you touch a single dollar. Here is the real reason most people get this wrong. They are making one-year decisions when they should be making 15-year plans. They look at their tax bill for this April and optimize for that single moment, completely ignoring what is coming down the road at age 73, 75, and beyond. The Project 120 approach flips that entirely. Instead of starting today and looking forward, you start at the end and work backwards. You map out your projected tax situation through required minimum distribution age, through Social Security activation, through the surviving spouse scenario, and then you reverse engineer the smartest moves to make right now. That backwards planning process is what separates reactive retirement from intentional retirement, and it almost always points to the same conclusion. This window, right now, is where the real leverage lives. So here is the core insight to take away from everything we have covered today. The right order is not simply taxable first, then tax-deferred, then Roth. That conventional sequence was never designed with your specific situation in mind. For the 55 to 62 crowd, the smarter order is running taxable spending and strategic Roth conversions at the same time, side by side, every single year. You are preserving your Roth accounts for last, letting them compound completely untouched while deliberately filling your lower tax brackets with conversions today. This decade is not just another chapter in your retirement story. It is the most powerful tax optimization window your entire financial life will ever offer you. The people who recognize that and act on it will arrive at age 73 in a fundamentally different and far stronger position than those who simply followed the default playbook. And if this got you thinking about whether your own numbers actually work, then you're going to want to watch our next video, where we take a real, honest look at retiring at 62 with $750,000. We run the actual numbers, not the optimistic version, not the worst-case scenario, but the realistic middle ground that most people never see laid out clearly. We are talking about withdrawal rates, Social Security timing, healthcare costs before Medicare kicks in, and whether that nest egg actually lasts. It is the kind of breakdown that might surprise you, and it could completely change how you think about your own retirement timeline. Click the video on your screen right now, and let us keep building this picture together.